I'm Keith McCullough, and welcome to our latest Investing Summit. This is our 11th summit. I can't believe it's been that many years and been so many real conversations. We're going to look forward to that for the next 3 days. We're going to do 3 in a row for 3 straight days, and we're going to start today with our leadoff hitter. I like to go with her first because she's not only one of the best strategists on Wall Street, but one of the real favorite human beings I have in my Investing Summit life.
Thank you. You're too kind.
Well, welcome, Lizanne. Thanks for leading off again today.
My pleasure. Looking forward to it. I always love our conversations. They fly in time, and that's testament to you. And congrats on the 11th.
Well, thank you. This is my old college hockey number. I love number 11.
There you go.
We were just talking about my 8-year-old. She wears number 11. So.
Well, don't stop at 11. Keep going with these.
We'll keep going. I generally start with you going through, and why we get along is because we have, not a dissimilar process. We have a similar approach. We have similar experience in the game, and I think that uniquely we've evolved, what we've done, and I think you die if you don't. So generally I like to start with the rates of change on both growth and inflation with you. This year we're going to do rates of change obviously on the deficit and the debt, but first I want to start with the market signals. I mean, according to me at least, in the market, the signals front run the economic outlook, and that's a real important thing, but I do struggle from time to time in terms of trying to interpret this U.S. stock market relative to a coagulation of other market signals, which are quite different for one, but uniquely American, I call it, and I dare call it uniquely American FOMO in isolation. On the U.S. breadth, let's just maybe start with that. I know you've done a lot of work on that, and just tell me what you see.
So you're right. This has been, and by the way, similar amount of experience. I think I'm a lot older than you. I think I sit somewhere on the spectrum between maybe you and Byron Ween, but I won't say any more about that. But
and nobody believes you.
I've seen my share of market cycles, being in this business since '86, and there's so much that is unique about this cycle for so many reasons. Probably most notably just the vagaries of the pandemic, both on the market related side of things and the economy related side of things. We're just about to, I guess, celebrate, depending on who you are as an investor, the 1-year anniversary off the low of, in the case of the S&P, October 12th last year. And it's been a fairly anemic move relative to, if you go back in the modern era history of the S&P 500 back to the late 50s, when it became a group of 500 stocks. The average move a year off of a major low has been a little more than 40%, and we're less than 20% now. But it's not just the anemic nature of the move, but the concentration issue, which really kicked in earnest in the May-June period of time, where you not only had such a massive bias in performance by the Magnificent Seven, you also had in mid to late May a record low percentage of S&P stocks that were outperforming the index overall over the prior 60-day period of time. That's improved a little bit recently, but it has rolled over. In terms of the traditional breadth statistics, I think Friday was, I guess, a little bit of a washout, and I think just the washout in breadth, where you were sub 10% in terms of percent, whether it's NASDAQ, Russell 2000, S&P, above 50-day moving average, that and the fact that the S&P sort of held at its 200-day moving average with going through it, I think probably brought some dip buyers in. And I'm talking to more people who are sort of looking at breadth signals, with a technical mindset, whether that's a good long-term strategy. But what's not really happening right now is what was happening last October. One of the reasons why that low, at least for a period of time, looked fairly decent was, even though the indexes were taking out the prior June low, breadth had actually started to improve before the indexes took out their lows. So, positive divergence, to use the language. And I think that held for a while. And then we started to see that concentration problem, which in and of itself is not a problem, but when you have such a small percentage of stocks doing anything well relative to the index, I think that was one of the setups for the weakness that kicked in late July, not to mention the surge in yields, which is the story.
Yeah, we'll get into that next. If you look, obviously, if the Russell 2000 is down 28% from where the cycle peaked, I mean, stuff like crypto, some of it's obviously, unfortunately, gone away, but you have that, Bitcoin itself down 65. I mean, we have some epic drawdowns, but the concentration remains. 90% of the S&P's return is in 7 stocks. And it's like, I've never seen that before. I mean, nobody's ever seen that before. So, but what we have...
Yeah, what else we haven't seen before a year off a low is dramatic underperformance by the banks.
Right.
In every case in the past, going back to 57, you've had double-digit strong performance, and in most cases, banks doing better than the S&P overall. Not always, but in most cases. And now we're still in negative territory a year in, another distinct difference relative to past 1 year off lows periods.
Yep. It's also like really interesting, if I'm old enough to remember, and I was not here for the 1991 recession. My first one was coming out of the 1999 one. I still don't believe you that you're older than me, and nobody else does either, so there you go. But
I'm a boomer.
When we look at this, and when I look at this relative to anything else, I mean, people will quickly, the old wall technical chart type that has like a moving average and one talking point, which is presidential cycle or seasonality, that's not what you and I do. I mean, no. I do make fun of it because it's funny. I mean, we live in a multi-factor world with multiple factors. You've been very good at analyzing, what factors you'd like to be long in certain environments. And that, like, we always try to remind people that, like, seasonality, what if you were getting long seasonality into October of 1987 when Liz Ann Sonders was just fresh on the job? I mean, that was not a good idea.
Not only that, but I think there's always approaches that get turned on their head. And I think another example of this unique period of time is that the Magnificent Seven, to some degree, are this cycle's defensive stocks.
Yep.
I think this year they became defensive in part because of the mini banking crisis, or whatever we're calling it now. I guess Jamie Dimon is using the words, banking incident, but that was really when the concentration problem kicked in to higher gear. And I think because those stocks represented big, liquid, strong balance sheet, high interest coverage kind of stocks, they became defensive again. It's similar to the fact that they were the defensive stocks during the lockdown phase of the pandemic, because they represented at that time the only ecosystems in which we were all living, absent a normal cycle. And it just shows you that the word defensive is a descriptor. It's not some predetermined grouping of stocks, just like, and this brings up the whole growth versus value debate that drives me crazy, because in the case of the value indexes, it's easy to screen for whether you're a growth stock or not, and know whether you're not a growth stock. And if you're not, then you get thrown in the value indexes. That doesn't necessarily mean you often offer value. Utilities, part of the reason why they've underperformed, even though they're classically defensive, is they were more expensive relative to the S&P at some point last year than ever. That doesn't make them value stocks. It just makes them expensive stocks that happen to live in the value indexes because they don't belong in the growth indexes. So there's so many ways to think about the labels that I think there's too much simplicity that's often applied to it. Things like defensive or growth and value, or even momentum. I think people think momentum automatically means, tech stocks, and momentum just means that that's a factor that continues to work. It can be in, energy stocks. It doesn't have to be tech.
Well, it did. I mean, what's interesting about momentum, and let's knock some of those pins down. Momentum as a factor exposure, defining, what these, I call them the MM7, or magnificently manipulated 7 stocks, which I think is largely a function of liquidity, which I want to come back to.
Right.
But back on momentum, again, I'm old enough to remember last week. I mean, at the lows of last week, when we're at the low end of my risk range, which is a typical place for you to bounce, not off the 200-day moving monkey, you had 6% of the S&P 500, 6% of the stocks had positive 1-month price momentum. That is like pretty near the it's definitely a decade low, but it's certainly a low relative to the game that I entered as a hedge fund analyst and then a PM, where quite literally my process is re-engineered to front run switches in 1-month price momentum, which is called my immediate term trade duration, which is 3 weeks or less. But when you look at that, I mean, that is a squirrel. I mean, that is telling you, okay, some bad shit is happening, or you wouldn't have 94% of stocks scoring that way. And then the alternative Isn't it like, let's just use both of those. I mean, we have momentum defined. Okay, it got a little better after 2 days on the second worst volume day, by the way, yesterday of the year. But okay, got a little better, but it's still bad on my scorecard. Isn't it liquidity that people are owning with those 7 stocks? Not some, like you said, like something that you want to label, but what it really is a place, if you're selling a 60-40 bond portfolio what completely blew up, or you can't buy utilities, you can't buy staples, you can't buy anything that is defensive in the traditional definition, you just got to flow $100 million or $100 billion in some cases out of bonds into those 7 stocks. That's liquidity.
Yeah, and absolutely. And that is, we talk about the cat bias. I think you're right. It's more of a liquidity bias. They're sort of one and the same with that type of grouping of stocks. And there are plenty of environments in the past when you're looking at cap weighted indexes where the large cap stocks dominate performance. Yep. It's when the other stocks are so significantly underperforming that divergence is when the risk kicks in, not just because you've got some of the larger stocks driving performance. That's the nature of cap weighted indexes, but it was, your 30-day momentum type stuff, the analysis I've done on the percentage of the index outperforming over the prior 60 days, you can look at that in a number of ways, but that was the setup, I think, for some of the risk that has unfolded, notwithstanding the last couple of days of better action.
Now, because liquidity is a thing, right? I mean, when you're running trillions of dollars on a neutral basis, and you can't be neutral to the factors that we talked about. You can't be long, anything pretty much. If you look at factor exposures since August 1st, high debt, look at anything like a high EV to EBITDA ratio in the S&P 500, high short interest, high beta. To your point, these 7 stocks have become relatively lower beta because they don't go down as much.
Right.
But these are factors that traditionally, let's bring it back to 1987. Liz Ann Sonders is sitting there and bond yields are rising and financials are underperforming while bond yields are rising. There's only one real time that I can go back looking at all cycles because it certainly wasn't during the Greenspan, entering the Greenspan recession or the Bernanke one. You had falling bond yields. So can you go back to that and let's start to get into the fundamental here where like rising bond yields, maybe the market's just telling you it's not just rising bond yields, it's an economy that can't handle rising bond yields.
Well, it's also the speed of the rise in bond yields.
Right.
Here's where I think speed matters more than level. I don't think it's really the case that the market or the economy can't handle 4.8 on a 10-year. It's the speed of that move. Yes. And the fact that as the yield curve started to steepen, it happened via a bear steepener, not a bull steepener. And that is what makes this spike in yields quite unique because the last, 3 or 4 steepenings, which in and of itself tell you that recession risk is still prevalent. It's the steepening off of a deep inversion that's the recession signal, not the inversion itself. But the fact that it's come with a bear steepener, meaning, long-term yields going up, bond prices coming down, it brings back what was being discussed in 1987 too, sort of the speed is something going to break, which brings you back to that desire for liquidity as we wait to see, what or if the thing or the things are that break. And I think that's all part of the story around the demand for quality and liquidity.
Yeah, and what about speed in bond yield terms weaponized by speed in the equity markets option structure? And we have on any given day now, it's north of 50% of total U.S. options that trade settle in 1 to 2 days. That is speed, max leverage. There's no anybody who's tried to run money with an options book knows that is one very good way to either have all your hair go white or lose it and then lose a lot of money. What do you think about that nature and how the nature of that structural implement into the game is not only being instructed by bond yields on some days now, but also becoming something that the world's really never seen since portfolio insurance, maybe?
I agree, and it's not just in play in things like the options market, the speed of the information flow, the things like a bank run happening at Twitter speed or X speed, the fact that decisions can be made, whether it's trading decisions or bank withdrawal decisions, can be made with the click of a finger on a smartphone. has completely changed the game. And I think there's the natural reaction on the part of many investors and traders is to similarly shorten time horizons. As someone that's a believer in long-term investing, especially for our group of investors, our little, $8 trillion worth of clients, are individual investors that for the most part probably don't serve themselves well consistently over the long term by trying to play that ultra, microsecond short term game, especially in the options market, where I think there's a disconnect between the probably the necessary knowledge base in trading options, which, by the way, I don't have. I will never forget. I found out I had to take the Series 7 sort of many years into my career, and I decided to do the fast track studying over the course of 4 days, and then take it on the following Monday. And just the little tricks, the person who helped me put the study materials together about options, and I thought, this is the kind of stuff that I'm going to pound into my head, regurgitate it onto the Series 7 screen, where it will stay for the rest of time. And that's exactly what has happened. So,
I mean, it's a thing, right? I mean, and I talk to, just like you, I mean, I speak to, I mean, our client bases are different, I mean, but they're the same in some senses. I mean, I have a lot of crossover to the RIA or the high net worth or the self-directed investor, but I could talk to, when he was back in the game institutionally, like Stan Druckenmiller in his office. Like you get to talk a lot, and what you find is that you're not alone, right? Especially if you're a boomer, Gen X, who's run money and or been at the switch, accountable to an opinion like we've been, or both. I mean, it's not easy, because the structure of the game has changed so quickly. Yep. But so has the thing that may be making bond yields go up at a fast rate. I know Jim Bianco, who I'll talk to next, has some explicit thoughts on this. But the pace of government spending and the pace of the deficit and the pace of the debt increase is now at like light speed. Can we go to that? I know you've done a fair amount of work on it, and I'll show a couple slides quickly so people can get their handle on, or their hands around, like what's actually happened here. So guys, if you go to the first slide on what we call the big G, or the deficit and debt part of the presentation, that shows the 32 trillion going to the next slide, which is 33 trillion in debt. And like, we're talking adding 250 billion in a weekend at this point. So I tried to contextualize that, like what is that in $100 bill terms. So, but of course, human beings, as you well know, Lizanne, because you speak to plenty of them, and you're in the mix, so to speak. They see that, but they don't know how to model that or measure and map that.
Right.
But if you show on next slide, slide 110, the rate of change of government spending was clearly the hero this year. I mean, whether it be through the actual GDP numbers themselves, which this is a massive rate of change rip, or the impact, I think, now on bond yields, and certainly on the sustainability of the labor market, because a lot of the government spending has been equated to government hires. So I said what I wanted to say about that just as an opening volley. What do you think about that when you see the rate of change of debt accelerating into an economic, or would that be a sign of an economic slowdown or the sign of the next expansion?
Well, we've had, sort of ever-rising burden of debt. It's been going up somewhat exponentially since the early 1980s. We were just in the era of great moderation, where we were in disinflation nearly the entire time, and long-term interest rates coming down. So the cost of servicing the debt was quite low, and therefore it didn't rise up in the attention of constituents or policymakers. Interestingly, I can't remember the last time, this goes back years, that I didn't get questions at client events, at other meetings that I would have with some of our investors about, when are we going to hit the wall? When is this finally going to come home to roost? The question would be asked in different ways, but my answer was always maybe the markets that sort of bring this more to the fore. And in our 2023 outlook that we put out at the end of last year, very wrong on, I thought the equal weight outperformance would have more legs. That clearly was not the case. But one of our key impressions heading into 2023, that concerns about debt and deficit and financing it would become a much larger part of the conversation. I think the fact that just this year hit debt servicing costs at 14% of tax revenues, if you look in the past when we've hit that, that's usually when sort of the concerns, the rioting starts. And it may be the, bond vigilantes, for lack of a better term, that are now forcing this out of the darkness and into the light. And it's part and parcel of the move up in yields being mostly about the term premium, not a huge surge in inflation expectations or some changed perspective on the growth trajectory. It's the, compensation being demanded, and it has to do with a lot more supply coming on and less demand on the part of foreign central banks and other foreigners. And maybe, individuals here just saying, you got to give me more yield for me to take the risk of going out the duration spectrum. And part of that story is definitely this deficit problem.
Yeah, you've seen and then people go down the rabbit hole on what the Chinese have sold, what the Japanese have sold. But they've taken a material cut to their percentage of ownership in the Treasury market. That's all happened, but what hasn't happened is an arrest of what we call the conditional or causal factors that are making this happen. And it's last I checked, government spending is inflationary. Is it not?
It depends on what form of government spending. But it's hard to sort of pinpoint what sat behind this inflation surge to one thing. I think it's obviously a combination of forces, but I think concerns about lack of fiscal discipline, I think, is absolutely part of that story, especially recently. And that's why, as you continue to see disinflation here, you've now got this massive surge in bond yields, and it's got ripple effects. The other concern here is that the something that breaks, we are seeing arguably a bit less interest rate sensitivity in segments of the economy, like the mortgage market, because of so much more of a bias toward fixed rate financing. There are a lot of the healthier companies termed out debt. Government didn't do anything that they probably should have with regard to, extending duration. I do worry about the shadow banking system and how much lending has been done there, and that's where there's opacity. And it's always hard to know what the thing is that breaks when you have a spike like this in yields. In 87, it in part was due to portfolio insurance, but I do have concerns about the shadow banking system because we just don't know enough about it to judge whether, cracks are really starting to widen.
Yeah, that's where the real non-linearity fun starts. And ends abruptly, by the way, as you well know. It's just like high yield spreads. You're like, oh, look, they look benign.
They're contained until they're not.
and then we just have a whipper, a ripper of a 3-week move in high yield OAS spread. And it's like we can talk about that, which maybe we should. But when people say, you use the word disinflation. Now, consensus will look backwards 100% of the time and have missed both, right? Like they didn't nail inflation going from 2 to 4 to 9. And then at 9, they're sure that you had an inflation problem. Then they completely missed disinflation, or what we call quad 4 and or quad 1, just the rates of change coming down. Guys, can you show that on slide 20? The quarterly peak was 8.63. But, you did in June, you had Wall Street essentially declare victory from both a bond market and a yield perspective, and really equities in July, I'd argue, with this kind of like, this Goldilocks scenario where you remember June, the headline inflation print was actually below 3. Now we have it going back towards 3.65%. So that's a reacceleration in inflation. That's not a decel anymore. That's a reacceleration. What do you think about that? Because we just addressed, bond yields could be going up through sovereign credit risk. Bond yields could be going up because we're going to get one more good GDP number. Bond yields could be going up because inflation's reaccelerating, or what I say, all three or all the above. But what do you think about this recent reacceleration? And in context, is that enough for the Fed to give Wall Street what they really want, which is a rate cut?
Well, I think we're in a more sort of volatile period for inflation, and I want to get to my longer term perspective on that because I think it's a topic that's not being discussed enough. But to the specific question about is it enough for a pivot, not just a pause? No, that's the narrative that has befuddled me for quite some time. This idea that just because we're in, albeit choppy, disinflation mode, that's enough to give the Fed a green light to cut with inflation still above their target. still tightness in the labor market as they measure it without any kind of significant dent in the economy, how could that possibly be a green light for an actual pivot to rate cuts after the most aggressive hiking cycle in 40 years? And that's what I think Powell has been trying to emphasize, the for longer part of higher for longer. And I don't think it's out of the question that the Fed might be cutting next year, but not under the current set of circumstances. A Fed that moves to rate cuts next year would, to me, only happen through a combination of continued disinflation to or near their target and more than just cracks in the labor market, bringing their other mandate into clear focus, which is they view as a weaker labor market being a necessary condition to keep inflation down. And the current set of circumstances, even if you can support a pause, which they could be in pause mode, pause and a pivot are two entirely different things. And the fact that the move to a pivot is often part of the bullish narrative, I always think, boy, be careful what you wish for if the Fed is going to have to do a 180 and start to cut, in the first half of next year.
Well, what's perverse about that is what just happened. I mean, I say Powell lied about it. People get all triggered because I said he lied. I mean, where I'm from, in Thunder Bay, Ontario, if somebody says they're going to do something based on a couple things you're watching, like the next couple inflation reports or labor reports, then you should probably do what you said you're going to do. And he didn't. He did not raise rates. And clearly, you and I can get into the weeds on the labor market data and where the cracks are. But that headline, NFP, was a two-bagger over what an old wall economist or a Fed one, which is kind of like a lesser paid one, would have looked for. And we're going to get this week, Thursday, I think, another acceleration in inflation. So he didn't go for the rate hike, but the bond market said, I'm going to raise rates for you.
That's right.
And that's what I wanted to ask you about next. I mean, here we have yesterday. Again, it's all part of the narrative. They need their cowbell back. You know it, Lizanne. And it surprised you. It surprised me. It surprised Danielle DiMartino Booth. I guess I'm the only guy that's surprised. I mean, all the Wall Street guys, are, this has got to go the other way, though, because I think they need it. They want it and they need it, but they're not getting it. So what do you think about that? It's been a long time since the bond market said, oh, you don't want to do that? I'm going to take oil up 40% in your face and raise interest rates for you, even though you didn't give the rate hike you said you were going to give.
Which I just did Wall Street Week on Bloomberg with David Weston on Friday with David Bianco, and we were both sort of in agreement that
Well, there's another guy who agrees.
that just wonders whether the one of the ways to arrest the rise in bond yields may actually be a more hawkish stance on the part of the Fed, so that they take the reins back to some degree. So far, you're not really hearing that. The comments you are getting from Federal Open Mouth Committee is that the move up in bond yields is doing some of the tightening for the Fed, and that's a reason why they can kind of back off. But what I think is more important than just the obsession that everybody has over the CME Fed Watch tool and what percentage probability is built into Fed Funds Future for the next meeting and maybe the December meeting. I think we are transitioning into just an entirely different secular environment than the so-called Great Moderation. And the Great Moderation, depending on who's using the term and what relationships or what metrics they're looking at, some cite that period as going all the way back to the early 80s in the post, Volcker, Slazy inflation dragon, early 80s through pandemic of disinflation the entire time and rates coming down. Others, like myself, think of it more as the kind of mid 90s up until the pandemic. And the period that preceded that, call it the 30 years starting in the mid 60s, I've been calling the temperamental era, just looked a heck of a lot different from the Great Moderation. And the Great Moderation had lots of themes and reasons behind why we saw what we did, one of which was everything gelled, GEL at that time. That's the acronym I've been using. The world had cheap and abundant access to goods, energy, and labor. And all three of those ships have sailed. And if you look at the 30 years that preceded the Great Moderation, we're starting to see some similarities. You've got the very significant inverse relationship between bond yields and stock prices. That was an era of not high inflation in perpetuity, but more inflation volatility. There was more geopolitical instability. Labor compensation was a larger share of GDP relative to its history versus profits. That was not the case in the Great Moderation. Profits went to a record share of GDP relative to its history. Labor comp, record low share relative to its history. Those are starting to converge now. Clearly, you're seeing the relationship bond yields and stock prices. You had more economic volatility, bigger swings. So you had more recessions, but you had stronger growth on the upside, some of which is because you didn't have the constraints associated with the high and ever rising burden of debt, which we already talked about. So I think that's a more important story. What does the secular environment look like? And it's not without opportunities for investors, but for a lot of investors, their investing lifespan only goes back to something within the Great Moderation era. And I just think it's different this time, and that's not dangerous to say in this case.
That is a tutorial, suffice to say. I mean, you got the gel in there and everything. I like it. When I started Hedgeye, I used to put the gel in the hair. It didn't work. I had, I will name it. Jennison. Here I am. Like, I'm not like you, right? I was a buy-sider, so I'm kind of like a troglodyte walking into these buy-side meetings as the new sell-side strategist, and it didn't work for
I was a buy-sider my first 15 years in this business.
You got to figure that out, right? I think it matters. Another thing.
I was a bottom-up, stock picking buy-sider, and I was always more fascinated by the top-down. So when the opportunity presented itself at Schwab nearly 20 some odd years ago, I said, yes, please let me do top-down.
And it helped having both experiences, being just on,
I think it does.
On one side. I mean, that's our bias and that's our experience. But away from the gel, which is a bad joke, the volatility of inflation and the volatility of the bond market and the volatility of everything, is it not perpetuated by the old wall, as I affectionately call them, begging the Fed to be their former Fed? By definition, you're going to, as soon as you take out a rate hike and oil rips 20%, and now the inflation number starts going up, you do perpetuate it by constantly having this.
You do, but I think not to the degree that existed before this current era. I think the Fed put, and what I mean by that is ultimately either in response to some sort of crisis, something breaking, or just a much weaker economy, that the default switch will go back to the ZIRP environment and NIRP in the case of global central banks. I think that is the ship that has sailed. I think that's the put that has been put to bed. And I think every central bank, probably with no or few exceptions, looks back on the experiment with ZIRP or NIRP and says, you know what, there were probably more negative consequences associated with that than positive consequences, both at the micro level of the lack of price discovery and the support for zombie companies, to the more macro level, pushing people out the risk spectrum that were income oriented. So I think that the Fed will pull the lever again and cut rates when it's time, or maybe when it's later than they should or sooner than they should. But I don't think that we're going back to anything resembling the kind of ZIRP environment that we had with us for a good chunk of the time from the global financial crisis on.
Yeah, Powell's actually been explicit about this, and he has, if you listen to him, God forbid anybody did, they wouldn't have been in a 60-40 portfolio or been long of duration this whole time. Just listen to him. And most importantly, listen to the bond market signal. Every week, my bond yields, whether it be on the short end or the long end, are signaling higher lows and higher highs. Like, you cannot even get the 10-year below 450 anymore, and the prior cycle high was 4.25. So that speaks to your point here that structurally it's not your old wall cowbell. You're just, and if you do that,
that's right.
If we're back in our buy side seats, I trade my book actively, as most people know. If I were in the club or in the elite club and I got to know when they said they're going to be data dependent but they're not, what would be the first thing I would do? I would go buy the living crap out of crude oil futures. That's where the juice is. Yeah, maybe there's some juice over here in what everybody owns, but That's not what everybody owned in the summer of 2023. And the market's very good at reflating asset prices if they get even a little bit of cowbell. So that's what I meant by, like, I think the vol is in people begging for the same question. I mean, yesterday, it was kind of crazy. I mean, the Fed, Dallas Fed, who listens to the Dallas Fed, but she says something about, hey, maybe the bond market's doing the work for us. I mean, yeah, but that's not the way you wanted it to go. It's an interesting thing, I think, to watch. Slide 62, I want to ask you about this, guys, in my deck. We call it going from Stagtember to Shocktober. Because, of course, a 40% rip in oil and a reacceleration in even headline inflation, which is already a reported reality, is Stagtember's news. But Shocktober, look at this list, Lizanne. Now, that's not like some presidential cycle or seasonality list. That list is a gong show of items that are real items that are part of your prior GDP, non-recession, soft landing, et cetera, that are all reversing. What do you think about that?
Well, wouldn't you add Hamas-Israel war?
Yeah, the list keeps getting longer every time.
Yeah.
Yeah.
And obviously that has a feeder into just general uncertainty, but oil prices as well. I think, it brings back the whole long and variable lags. And I've been saying we're just not past the expiration date on the hits that come at different times, and there might be offsetting circumstances, like I already talked about, with regard to things like why mortgage rates maybe haven't hit to the same degree they have in the past, because more people have locked in fixed rate mortgages, and therefore the effective mortgage rate on average is about half of where it is. And some companies took advantage and shored up balance sheets, but I still think there's still a coming home to roost environment here as it relates to weaker companies, the zombie companies. It's starting on the consumer side of things, admittedly down the income spectrum into subprime, where you're looking at delinquencies or lateness on auto loans or mortgage loans, and eventually it starts to creep up. We got support for all of those concerns with the NFIB data that came out today, and you've seen a deterioration in confidence, and you've got inflation now back up to be tied as the number one concern with concerns about sort of labor broadly. And I think that student loan payments that you point out, and there's always a lot of debate about this sort of excess savings, and with the broad benchmark revisions that we just got to GDP and its component parts, you did see an upward revision to excess savings, but it's still coming down. Maybe you have another quarter of some semblance of cushion, but the last thing I'd say is we think of a lot of this, just the inner workings of the economy or even inflation, as very kind of quantifiable. They're metric driven, but animal spirits and psychology doesn't just drive markets. It drives inflation. It drives the economy, and that is the thing that I think could be one of the things that breaks, is sort of the confidence part of this that feeds its way into, again, not just markets, but inflation has a lot that's psychological about it, and the economy has a lot about it that's psychological.
Yeah, I mean, if you go to Stu Leonard's, which you still live around here.
Very close.
Go to Stu Leonard's on Saturday morning and go up to a mom with her 3 kids, or a dad, in my case, with my 4, and just hold up a sign saying there's no inflation. Disinflation is here. Like, I mean, it's so ridiculous. And obviously the consumer confidence rollover was almost right on the screws with what happened in oil prices. So that's a really good point that I infrequently hear.
Not only that, but everybody's inflation is different. This focus that we all have on some, either PCE or CPI, and if it's trending down, it's a good thing. But yeah, talk to the average consumer, and people who, eat food and drive cars, and they feel it.
Yeah, I mean, and looking at that list that I'm talking about, Shocktober, that's taking away a lot of the benefits that people had post-pandemic that they needed, right? And we're talking about SNAP benefits, we're talking about even these ERC payments, which have blown up into a big topic, obviously. There are a lot of things there that people needed to make ends meet. Questions in the queue, if you have questions for Liz Ann, I got about 5 minutes left here. And the first one, not surprisingly, is about the other side, or the highest rated question, Liz Ann, is about the other side of that. People that are perma-bulls want and need to believe that we're just gonna have a great end of the year. And so this question, not to pick on that narrative, but it's right on the screws. People want to believe that and make it that simple. So that's the question. Good morning, Liz Ann. Notwithstanding the negative economic outlook, notwithstanding anything Keith and Liz Ann just talked about for the first half of next year, he actually says as well, I'd like to hear your thoughts on whether stocks can have a reasonable chance to finish strong anyway.
Sure they can.
Yeah. Anything can happen.
Of course they can. If only because of the whole, bring out the old adage of, wall of worry. That absolutely can happen. And triggers could be another better than expected earnings season. You've had a bit of the washout in breadth conditions that tends to bring dip buyers in. So yeah, I'm never surprised by any move on the part of the market. But I think there are still a lot of risks out there, and I think there's ways to navigate through those risks versus, get in, get out. It's probably the question that drives me most crazy that I often get from kind of traditional financial media, especially during maybe a more tumultuous, week or month or day in the market. The natural questions, okay, Liz Ann, what are you telling your clients to do? Get in or get out? And I always think, boy, what a dumb question. Neither get in nor get out is an investing strategy. That's just gambling on two moments in time, and that's not what investing should be. A disciplined process. Yeah. Over time, and to be successful, it doesn't require that you know exactly when the bottom is or the top, and you have an explanation for a rally that doesn't seem to have backing by fundamentals, or vice versa. A market that goes down even though the fundamentals seem terrific. So back to the honest answer, yeah, the market could go up into year end. Sure, why not?
Yeah, I mean, it's just like, yeah, you can hit on black in a casino too. I mean, like you said, it's gambling. That was one of the best answers I've heard from you, and for a lot of people, because it's human nature to want the simple answer, and we have a nonlinear system, a chaotic system. That is what nature is. This is not new, and it's just not that easy. I mean, just not even remotely close. But the one thing that's been 100% certain, and it's only happened at least while we've both been in this business together in the last quarter century, there's only been two recessions that we've, three if you include the pandemic, but the two broadline recessions that we entered. Once you actually get into the recession, then that is not a positive outcome for your stocks. I mean, that's and I guess that's my last question for you. I mean, I could show, like on slide 17, guys, like we have us entering this year. There was no recession. But we have the recession starting.
There's been no declared recession. If the data that the NBER tracks gets progressively worse from here, it's not out of the question that when they very late in the game announce a recession and then backdate its start point, that we might find out it was already underway. I'm not saying that's my thesis. That's just the nature of what the NBER looks at. The fact that when they finally see the sort of whites of the recession's eye, and then they go through the process of, okay, when did it start by month? They go back to the peak in the data, which is why, my other thing I always say as it relates to economic data, it's human nature, to use your term, to look at economic data and think good versus bad or strong versus weak, but it's better or worse that matters more than good or bad. Yep. And it's that rate of change, it's inflection points. And plus the fact that we've had segments of the economy, I get a lot of criticism for using rolling recession. Come up with a better term for it. I don't care. But we've had pockets of the economy, housing related goods, manufacturing, that have gone into recessions. We've just had the offsetting later strength on the services side. That's the nature of the pandemic. We had the goods pop initially, and then the goods recession. Now we've had the services pop. And, to me, best case scenario is not so much soft landing is we've had hard landings in those areas.
Yeah.
It's just that if and when services gets hit, which probably hits the labor market, that you've got offsetting stability in areas that have already had their recessions.
Yeah, I mean, a hard landing, you could find that in your account if you've been long like real estate stocks, from the cycle peak. They're down 35%. It's worse than the Russell, which is hard to do. I mean, that's an important answer as well. It was actually the guys, I was showing the wrong slide there, slide 19. It's almost, I hear you on looking backwards, it'll all become crystal clear, but in our nowcast, we actually have us entering the recession now, right? So you're going to get those numbers. Like to your point, you're not going to, the traditional economist or somebody at the Fed will be the last person to figure it out. But I mean, you're entering it, according to us, now, and it'll be blazingly obvious to the Fed, by the middle of next year, because those are 3 sequentials in a row. They're not, that's not something that if that ends up being right, Lizanne, that would be the equivalent of, like, even in 2007, like when I was early and wrong, I got fired in November of 07. GDP in the third quarter of 07 had a 2 in front of it. And obviously, I built Hedgeye on the back of staying with that process and call and rate of change terms.
And pre-revisions, payrolls looked great.
Yeah. Well, they always do at the end, right?
Yeah.
And it's the last thing that looks good.
Right.
So I guess
keep in mind that the NBER didn't say it's a recession until December of 08, at which point they said, oh, and by the way, it started a year ago.
Yes.
At which point, I think at that point, everyone was like, well, duh. But that's also what I tell people, like, there's no recession. Well, just because it's not declared by the NBER, keep in mind that the average lag for them in dating the start of recessions is 7 months. By the way, it's 15 months at the back end between when they've said, okay, recession's over, it ended, the average look back is 15 months. So, man, I certainly, if you're trying to time the market, don't use NBER declaration dates as some trigger.
No, use Lizanne. She tweets every single day. We have to. You do an awesome job. I know that you're proud of that. It's like it's going to be your legacy. You get up in the morning and you grind and you give people like real rate of change data, real perspective. I don't think I've ever read anything that's politically charging. It certainly doesn't trigger me.
I stay away from that. And I also have to do a shout out to my research associate, Kevin Gordon, who's my, chart maven. So I give him a tremendous amount of credit for the rapid fire visuals that I'm able to put out there on X, formerly known as Twitter. Yeah,
it's a real, like, you're one of my core. I have my contra stream, to be clear, but which is literally, if you watch Lizanne's tweets and you watch the contra stream of the pump from Wall Street, you're going to see very different things in the morning. It's an interesting exercise that you should all engage in, but you're always evolving, but you're always the same in terms of being a great person for the kickoff of our Investing Summit, and I appreciate you making the time.
My pleasure. Nice to be here.
She is Lizanne Sonders. There's only one. And up next, it's going to be Jim Bianco.